Welcome to the session of the Institutional Investor's Perspective. My name is Heather McGee. I am the Chief Operating Officer at 17 Asset Management, an impact finance firm designing investment products that generate both a financial return and contribute to the achievement of the UN Sustainable Development Goals. This past year, we have seen billions of dollars in the US alone being pledged towards investments that are addressing the racial wealth gap. We are looking to explore the authenticity in those commitments, the effectiveness in those commitments, and the approach to those commitments. All three of the firms represented here today have communicated commitments for change. We wonder, with all the money being committed, are there enough investment products that are properly structured with the right elements to deliver on the commitments, both financially and impactfully? Today, we have an incredible panel to give feedback on these questions. Starting with, we have with us today Ray Ramsey, the Managing Director at Lafayette Square, which was founded in 2020 with the mission of being the leading provider of impact-driven capital. Ray is an American social justice entrepreneur and author. And in addition to his role at Lafayette Square, he also serves as founder and CEO of Century Tech. Ray is a director on numerous boards, including Morgan Stanley Institute for Sustainability, MMGL Real Estate, LISC, and the Washington Jesuit Academy. He is interim CEO, trustee, and member of the investment committee at Nathan Cummings Foundation. Also with us today is Andy Rachlin, who is the managing director for lending and investment at Reinvestment Fund, which is a community development finance institution, or CDFI, based in Philadelphia. Andy has been at Reinvestment Fund since 2012. At the firm, Andy oversees business development, credit analysis, and transaction structuring across asset classes, and takes an active role in new product development. Andy also founded and serves as the Chief Investment Officer of the firm's Registered Investment Advisor subsidiary, through which Reinvestment Fund raises and manages a family of private funds focused on community development and clean energy initiatives. Paul Rabinovitch is principal of real estate at New Island Capital, an investment firm exclusively investing into positive solutions to the world's most pressing problems. At the firm, Paul employs real estate impact investment strategies to improve the quality, resilience, and vitality of communities, as well as our overall planetary health. So that is who is with us today. We are lucky to have such an esteemed group of institutional investors here to dive into our conversation. And each of you have a particular interest in Philly. And so if I could, I'm going to turn it to each of you to ask, to share with us what your personal relationship is with the city. And maybe Ray, I'll turn it to you first.
Well, it's easy because that's where my family brought us up. And many years ago, my mother's people came up from New Orleans and my father's people came up from South Carolina, and Philadelphia was the meeting spot. And so I have family in North Philadelphia. I was born and raised in West Philly. And so once a Philly guy, always a Philly guy. That's really it. And when we started this new firm, Lafayette Square, we decided that we would select certain cities to work in, and I had a twinkle in my eye for Philadelphia. So here we are.
Lucky Philly. Well, Ray, glad to have you here. Andy, we'd love to hear from you what your personal relationship with the city is.
Sure. I am proudly a Philadelphian by choice. Like many, I suspect, young people, I did a stint in New York in my early 20s, and there came that existential moment where I asked myself, do I want to be a New Yorker? And I had this epiphany that there was a better way. And so I thought about the different places that you could make a life and a home. And for lots of reasons that I think we'll actually get to talking about today, as we talk about why Philadelphia is a great city for real estate investment, I chose Philly, and I was lucky enough to get to come here and work in city government and work at the school district and be at the Reinvestment Fund, which is a longtime Philly organization. And so I've gotten to become, in my little way, that probably would not be recognized by lifelong Philadelphians, a local.
Awesome, Andy. Paul, we'd love to hear from you.
Sure. Well, thank you for inviting me to speak, and it's an honor to join Ray and Andy on this panel. And like them, I'm also proudly identify with being a Philadelphian, even though I don't live in Philly anymore. But I was educated in Philly. I lived in Germantown and went to high school in Philadelphia, and also went to University of Pennsylvania. And then following that, I followed in my mother's footsteps, who is sort of a pioneering female developer, which 30 years ago was pretty rare to have a female developer working in Philly, and started working with her in developing various communities in and around Philadelphia. So I've redeveloped areas in Manayunk, West Philly, Northern Liberties, South Kensington, for affordable housing, urban infill, historic preservation, all sorts of different types, and got to know Philadelphia really well and its communities and the landscape and the people there, and we'll just always have a warm feeling about Philadelphia, its growth and its future. Thanks again for inviting me.
We're glad to have you here, Paul. Well, so all three of you are here today representing very different institutions, and so maybe to give the audience a little understanding of the different types of organizations you're at, we can do a quick speed round, and we'll start, Andy, with you. And the questions are, describe the type of investor you would describe yourself as, your investment approach, the types of investments you make, and the typical range in transaction size.
Sure. So Reinvestment Fund is effectively a boutique private credit fund, if we had to sort of use the words of the financial services world, focused exclusively on impact investing. We work across the country, but with particular focuses in a couple of markets: Philadelphia, Baltimore, DC, and Atlanta, and across some specific asset classes: education, healthcare, housing, clean energy, and sort of broadly speaking, commercial real estate are our primary areas of focus. We do mostly what I would call project finance, frequently real estate, but also other kinds of equipment or physical infrastructure, and some what I would call corporate finance, although frequently it's really to a nonprofit, or it's not traditional corporate finance. And our transaction size ranges fairly widely. Our smallest transactions are probably generally in this $200,000 range, and they go all the way up to about 10 million. And we finance somewhere between sort of 170 and $220 million of transactions a year.
Awesome, Andy. Exciting. Paul, we'd love to hear the same from you on your side, what your type of investor you are, investment approach, range in type and transaction sizes, and the types of investments you make.
Sure. I think I'm gonna start, Heather, with making a quick distinction. It feels a little bit funny for us to be called institutional capital, and I think we do qualify in terms of the size of the AUM that we manage and the check sizes and such that we deploy into. But I think it's worth this panel to just explore for a minute the institutional capital ecosystem. And I think, at least for us, and I think I might be speaking for Andy as well, and perhaps Ray, we're sort of, to use a natural systems, we're sort of the pioneer species of the ecosystem. We're looking for great growth opportunities, but not in the safe and secure, stable communities. We're the type of capital that's pioneering, opportunistic, maybe edge species if you're a botanist or a biologist. And that's the kind of places where we thrive. And we hope to move into those areas, prove they're safe, they're stable, that they're viable, and then hopefully encourage other capital to follow us. So we're not in that mainstream capital. We're not that looking in the mature forest. We're looking, and that's what makes this work that we're going to be talking about here in Philadelphia so exciting. So I just wanted to make that distinction, and I think some of the hallmarks for us is that, in order to survive and thrive in that sort of strategy, you need to be fast, you need to be nimble, you need to be creative and flexible, and work with partners, which I think is what we do, where they're at, and not be, one size fits all. This is how we do business. Here's your legal agreement. Sign it. So going back to your original question, we work across a spectrum. New Island Capital Management works across a spectrum of different strategies, including private credit, private equity, real estate, and real assets. So we can engage on a lot of different levels with communities in terms of helping businesses grow, standing up real estate projects or platforms, well, if someone has a great urban farming idea, then that's something we'd be interested in too. And typically our check sizes are 10 million or more towards those strategies.
Great, Paul. So good to get that insight. And Ray, last but not least, we'd love to hear about you at Lafayette Square.
Sure, and happy to talk about us. Because we've only been around for not even a year. And,
right.
And I say, we had a founder that, like many of us, felt really unease with the George Floyd situation, COVID, and what was going on in the country, and the unrest. And so we were basically birthed out of that. And I look at it as sort of the hopefulness that comes out of that restlessness and that lack of hope. And suddenly several key players in the country came together and said, we're going to create this diverse owned platform so that we could put money out across the country and really focus on solutions. So we are place-based, solution provided capital. And so we're looking to municipalities to work with them in partnership to solve a series of issues. And we're really looking at large macro issues. A lot of the things that we're going to talk about today, the wealth divide that exists in our country based on the color of someone's skin and other key issues like that. So when we view putting capital into communities, it's not merely deploying capital and getting that as a return, but we're looking at what else comes because of that. And it's really the deep meaning of impact. And I'm looking to getting into that because I have a concern across the country that this has become the latest tagline for just capital that wants to do exactly everything pretty much the same. So we work in multiple asset classes, affordable housing. We're creating business development corporations, BDCs, in regions across the country. So we have a strategy to drive impact in a number of communities across the country. And we're very excited. And we've got people that come from private capital, people that come from impact investing, and people who come from community development, all converging together. So it's pretty exciting.
Very exciting, Ray. Really cool. Good luck with all of your efforts there. And following on these themes, I'm going to take it to you, Paul, first. As an asset management firm that reflects the interest of a large family, how are you achieving the objectives of the family that you represent?
Sure. Thanks for the question. So New Island Capital Management works on behalf of a single family. We're, for all intents and purposes, we advise a family office. And we have the great privilege, really, of not only managing their wealth for them, but also being given a lot of latitude in terms of what we can invest in, what we can explore, how we can create change. And that's really one of the only mandates that we have, which is that our capital is intended to create change, that it has a positive social benefit. And at least in real estate, that positive social benefit should fall within three very broad areas: the environment and sustainability, and improving planetary health, economic inclusion, which at least in real estate includes affordable housing, but in our other strategies can include lots of other strategies about how to make credit available to various people, and then racial justice. Those are the three main outcome areas that we seek to achieve on in our family, and that's how we achieve the objective of the family. That the name that we have, New Island Capital Management, really relates to a vision of creating a new paradigm for all of us to live within, creating a new island. So that's us.
Awesome, Paul. Well, moving on to Ray, there has been a lot of major financial institutions that have made big commitments to racial equity. How are you helping that process at Lafayette Square?
Well, look, I look at it this way. I don't view it as our job to sort of help that process per se. I think it's about taking capital from multiple places and making it work for people. And I think when you look at, the traditions, that have happened, particularly in real estate, and you just go back and you study it, a lot of wonderful physical structures are built. And, and then you look at 10, 15 years later, and there's blight and dilapidation, starting. So the goal is the hope that we can show and be one of the players to show that we can deploy capital, and we can deploy it in a way with our eye towards something deeper than, putting up a building. Because that's proven, whether you go all the way back to, the neighborhood renewal programs in the 70s and the robust community development movement in the 90s. We are exactly where we are. And most of the cities, if you look at the statistics, have the same level of poverty rates, if not larger, despite all of that money being deployed. So I would argue it's money plus, and how do you add the plus to the money? Because we know that the money still needs to get a return, but we've got to be more serious about the other parts that go with the return.
Absolutely. And I know Lafayette Square is pretty serious about the plus, as is Reinvestment Fund. And so taking it to you, Andy, in your community-based investment, Reinvestment Fund, how do you use your strength as a nonprofit to achieve the objectives that you would like?
Yeah, I would say there's two things. First, Ray mentioned the challenge of money wanting to behave the way that it's always behaved, but somehow get different results. Which, is perilously close to the definition of insanity. And so one thing that we're able to do now, as Reinvestment Fund, we are a borrower. Most of the money that we lend is borrowed from somebody else. And as an investment advisor, we're managing other people's money. We're a registered investment advisor. So we have an obligation as a borrower to return principal and interest to our lenders. We have an obligation as an investment advisor to, steward our investors' money with fiduciary duty. But because we are a nonprofit, because we only work with investors and lenders who are mission aligned to us, the table is set with a mandate and a set of expectations that we are not profit maximizing, that we will not behave in a profit maximizing way, and that we will balance the need to repay lenders and steward the money of investors with the need to achieve impact in the communities we serve, and that we can make very concrete trade-offs sometimes to enable both. And that is not outside the reason that people come to us to manage their money. It is actually the reason that people come to us to manage their money. They expect those trade-offs. They look to us for those trade-offs. And I think being a nonprofit is part and parcel of that. It's an expression of an unwillingness to profit maximize when that stands in opposition to impact maximization. The second thing that being a nonprofit allows us to do is hopefully communicate with the communities we serve on the basis of more trust. Because again, there's an expectation that we are not coming in for the purposes of profit maximization. I want to speak with humility around the ways that has gotten harder as we've gotten bigger and as we've started to serve more communities. I don't think that we have perfected that art at this stage, particularly as we continue to grow. And I want to make sure I communicate humility around that. But I do think it continues to be important when we come to the table on a project or as part of a policy initiative or at a round table that a politician has convened, that we're coming from a nonprofit place, not a for-profit place, and that brings us with a different face to the community and allows them to show up with a different face to us.
It's great, Andy. It's exciting to have all three of you representing institutions that are committed to the bigger picture and the impact that finance investments have, no matter whether they account for them or not. So moving to the overall perspective on Philly for all three of you. So we would love to hear, and Ray, we'll start with you, just kind of keep going around the circle. And do you see Philly as worthy of investment? And second, what are the particular aspects of Philly that you're interested in?
Well, other than it being my hometown, of course, the answer is yes. So again, that's easy. And it is. I mean, when we look at a geographic location, you factor in a number of things. One is, can you access that market? So as an investor, capital doesn't want friction or tension in terms of entering a new market. And so I think it's a very accessible market. There are folks like you there, the collective, other organizations that we've already in a very short period of time begun to work with. So it's an accessible market. Second thing you look for is, and for Philly, this part is easy because the unfortunate thing is it's one of the poorest big cities in the United States in terms of poverty rate. So is there need for this kind of work? The answer is a resounding yes. And then lastly, opportunity. And so the flip side of the need part is the opportunity. And it is a city that is eager to attract additional capital and is willing to work with you to deploy that capital. And there's some great civic strength there, in social capital, in community-based organizations, intermediaries like LISC and other organizations that exist there. So it creates an exciting ecosystem of players in order to work with. So I'm bullish on some good things can be done. Again, I think there's a lot of work to do to connect the dots and make sure that the economic participation is more built in to the work of finance.
That's great, Ray. Couldn't agree more. Andy, on to you. We'd love to hear your perspective as to, do you see Philly as worthy of investment, and what are the particular aspects that you are interested in?
Sure. I admit that I'm a little uncomfortable with the wording to the extent that like any place with people is worthy of investment, right? And in fact, places without people are too. But I absolutely do. And I think I'm a little bit saying in different words what Ray also said, which is that, another way of looking at poverty is an expression of untapped human potential. And where untapped human potential exists, so does opportunity. And the question is, how does it unlock? The macro history of wealth creation and the measurable improvement of human life in terms of health and lifespan and stability and all of those ways that we measure quality of life over not the last 50 years, but the last hundreds of years has been about creating wealth where there was poverty. So to me, Philly, continues to represent that opportunity.
That's great, Andy. Paul, last but not least, love to hear the same from you.
Tough to follow these two. I think they've ticked off many great reasons why Philly's great. I'd add two to our list. One is I think it's worth noting that investing in Philadelphia somewhat depends on your perspective and your investment strategy. And for us, it's well suited because we look to be long-term investors. We have a 10-year horizon plus. At least in the real estate transactions that we do, we consider ourselves as, possibly never sellers, acquire or build properties and then preserve the impact, whether it's affordability or inclusion, by holding it, not exposing it back to the market where someone might change it around. So Philadelphia is such a stable market. It has been so predictable for so long that it's well suited for an investor with our perspective of 10 years. There's lots of other institutional capital and others who want to do momentum plays in fast growing markets. They want to come in and out in 5 years and so forth. And perhaps Philadelphia is also suited for that, but I think it's best suited for for investors who have a long-term view. I'd add to that. I also think on a macro scale, which will help Philadelphia, is we're at an area, a time of history where there's this confluence of factors that I think making investing in urban areas, especially in real estate, particularly opportune. Where we have opportunity zones in place that give pretty powerful tax benefits to those who can deploy through opportunity zones. We have historic low interest rates, and we possibly have infrastructure financing coming to complement all of those actions. So there is a possibility of this really strong tailwind to help rebuild and build our communities and our cities up from across a lot of different areas, from affordable housing to accessibility to transit oriented. And so that to us, I think when we look at it from that macro perspective, we think Philadelphia would also benefit from all of those kind of tailwinds, and it makes more sense to go to Philadelphia and other places that are well connected, other cities that are well connected by transit, and other cities that have great access to education and resources.
Thank you, Paul.
Yep.
Moving into the real estate opportunity in Philadelphia specifically, and Andy, we'll have you take this one away first. What would be some of the considerations and requirements you would look to have in an investment structure that is real estate focused in Philadelphia?
That's a good question. So structure, like in terms of investment structure, I don't know that my requirements in Philly would be particularly different than my requirements anywhere else. But I would say that in terms of investment strategy, to go back to some of the points that Paul made, a long-term view is important. Philly is a city that has boomed and busted less than other places, and I think that's likely to continue by virtue of the sort of industries that call Philadelphia home. So long-term view matters. It's not as good a city for like quick in, quick out. I also would look for an investment strategy that seeks to take advantage of what I would view as some of Philadelphia's greatest strengths from both an economic and an impact perspective. One of those, for example, is the sort of great abundance of space relative to population size. If you think about Philadelphia relative to cities that have boomed much harder and created much more stress, especially for low-income people in those places because of those booms, places like New York or Seattle, they are physically much more constrained than Philadelphia. Geographically, there's just less dirt relative to population. And so investment strategies that seek to capitalize on that and create economic opportunity while avoiding some of the pitfalls of what we might call gentrification are sort of especially attractive, again, both from taking advantage of, economic opportunities like low land costs and impact opportunities like development without displacement.
Great answer, Andy. Paul, taking it over to you, would love to hear what considerations and requirements you'd look to have in investment structure or strategy focused on real estate in Philly.
Sure. I'll say a few things. One is just overarching. We are relationship-oriented investors, not transactional. So what we're looking for is to establish a relationship with a sponsor that will be long-term, as well as with the community that we're investing in. And so, as I said earlier, we are long-term investors. We contemplate that there will be other opportunities to continue our investment, either with our original sponsor or in the community. So we're looking for, to use a nonprofit word, the theory of change in the area that we're going into, and does it make sense? And is there a way in which we can see that this community is going to have like a steeper trajectory with the capital that we're deploying, as well as other people's capital. And that's an important component to us, is we don't necessarily look to be, the sole capital provider. We try to find other capital that are coming into the same community, capital like, the TRF or public sources or other private capital, as just indications and validations, and also greater success, less risk, that this area can succeed. In terms of working with sponsors, we really look to them to have a commitment to impact, and a commitment, that drives through their whole organization. Candidly, we've had really poor results when we worked with conventional sponsors and tried to have them create impact. That those results tend to be fraught. So we look for partners where it's part of their DNA. It's in their mission statement. It's part of how they do business. And we also look for developers who've had a tight commitment and engagement with that community, perhaps for a long time. We don't invest with folks who are overriding community wishes to build something or put something in place. And then we have a whole impact checklist that's probably, I don't know, about 30 different items, 30 different aspects, ranging across what I mentioned earlier: sustainability, economic inclusion, racial justice. There's a lot you can do in a real estate transaction to include many of those things, and we like to try to include as much as we can that benefit the business plan.
Paul, it's great. That's why we named the event Real Estate as a Portal to Change, because there's so much that you can have impact on in real estate development if you are kind of working to meet any of those probably 30 requirements you've listed. And I know Ray, Lafayette Square's got some large anchors around that. But perhaps just on this, we'll get into impact measurement in a minute, but around investment structures or strategies, what are the considerations and requirements you have or look for around real estate?
We've heard most of them. I mean, by the time you go last on a question like that, it's all pretty much been addressed. And I'm not going to bore the listeners with structures. You're financially underwriting the project. You are underwriting the organization itself. And so you're looking into, and you're doing due diligence on the entity, and then you're ensuring that there is a thesis of impact, that there is a likelihood of that being executed. And I think we all are aware of what those core impact areas are. And then we've got a particular focus on wanting to work with, not to the exclusion of others, but work with diverse either managers of other funds or diverse sponsors. And so spreading the wealth effect, there's nothing more powerful than when you think about wealth than who owns the project. And so that is something that we are putting a lot of emphasis on, and we will be launching a foundation very soon, even though we're a pretty new organization, and we're committing a certain percentage of equity from the parent company and a certain percentage of profits, and we're seeding it with some money. And the whole focus is on diverse entrepreneurs, because we think that's one of the most, and I'll chair that foundation, but it's one of the most important things that we can do, because that addresses the dynamic of power and where that power sits and who sits across the table in what position. And I just think that's got to be more overtly addressed when we talk about capital.
Awesome, Ray. Glad you went last to clean it up with that. So moving on to why we're here today with the collective and the collective investment group. I know each of you have had the opportunity to have initial conversations with the management team or the leaders of the investment group for the collective. And the investment strategy is in its final stages of design, working to be launched in May. And starting with you, Paul, and then you, Ray, What are each of you hoping to see for an investment opportunity like the collective to accomplish and perhaps have as components to its features?
Sure. I shared earlier that most of our, our minimum check size is $10 million equity into a project, and the project needs to deliver tangible, real impact. And I'm here to tell you that when you look across the country, the number of sponsors that are out there, developers who are able to deploy that size check and achieve impact is small. And there's not that many of them across the country. In fact, we tend to look for the developers first and then underwrite their market rather than the other way around. Then if you apply another filter and say we want to apply a racial justice filter and only invest in Black developers and Black sponsors, then it becomes even smaller. And there's lots of structural and systemic reasons why that is. And so, one of the things that really attract us to what your approach is at the collective is that this gives us a chance to deploy $10 million, but to have that $10 million allocated across a lot of really talented developers who can then become the next generation that we can invest in directly or others can invest in directly. There is a great need to develop the bench, and the new starting rotation for impact-oriented developers. And I think that this is a great conduit to do so.
Thank you, Paul.
Yeah.
Ray, we'd love to hear your thoughts on the same.
Yeah, I think, I met with you folks, I think it was maybe a year ago. And so the progress that's been made is really laudable. And I humbly, I can say, I think, you're off to a good start. The key is that, working with people so that access and information and processes and forms and documents can all be demystified. I think that one of the big roadblocks is sort of the information haves and the information have-nots. And I think that there's a lot of mysticism attached to investing and development and all of those sorts of things. So the more that we can share that so that people's skills can be on display and not these, artificial walls that have been created, it's what's held all of that untapped potential back. And so it's really got to be, it's like pulling that back and allowing more people to get into the game, have that seat at the table. That's what I meant about the dynamics of power. Because when you can come to the table like that, far too often, and there's developers that we're supporting now, very soon. It's not public yet, but they get involved in projects and they wind up doing the vast majority of the work. But because they're not showing up with equity or the balance sheet, they're just literally working for someone else, even though they're called a developer or a co-developer. We've got to have a lot less than that. And so when we think about what we're attempting to do, those are some of those dynamics that I was talking about. Real estate can be extractive or it can be inclusive. And I think it's a matter of making a choice, and where do we want to land? And what you're doing, what's happening with the collective, it creates a vehicle to be able to achieve some of the things that I'm talking about and others are talking about.
Thank you, Ray. That's great. Andy, last but not least.
Yeah, like Ray said, when you go third, there's not that much else to say. I guess feeling compelled to add something. I think two things. The power of your proposition at this moment is significant and has the potential, to my mind, to, going back to the things that Ray and I were saying earlier, convince investors that this is the moment and this is the opportunity to behave differently and engage in a fund that is profit-seeking, but not to the point where it is unfairly extractive from the developers doing the work. That it, I've been very pleased to hear from you, your focus on making sure that the the bulk of the wealth creation that comes from the projects that the collective will invest in will stay with the entrepreneurs doing the work for all of the reasons that that accrues to power in the way that Ray and Paul were talking about. And then second, the significant intentionality you have around not just, as the name suggests, not just being a vehicle for capital, but an ecosystem where there is transparency and the ability for lessons to be shared and mutual strength to be developed. And that you've put together an initial group of developers who were at lots of different places in their career, developing at lots of different scales, lots of different kinds of products, and that you're creating a platform for them to share and share alike, not necessarily the money or the projects, but the knowledge. That's very, very powerful and exciting.
Could not agree more, Andy. That's why 17 Asset Management got behind the collective so robustly when we essentially found them, and better together, right? As the name suggests, the collective, they're stronger together as developers and community members. So moving into one of the question on impact measurement, I know you all have been sprinkling it in through your comments as it's baked into who you are and how you approach your investing, but just calling it out more directly. What are some of the impact measurement elements that your organization looks for when it comes to outcomes for your investments? And Ray, we'll start with you.
Yeah, the first thing I would say, and again, I think this is going to be one of these topics where you're going to hear similar threads from everyone. So rather than giving a laundry list, I just want to give a broader perspective on it. And it comes from the place wearing my hat as an LP, running a foundation. It's a growing, evolving area when you talk about metrics. And I always say that we have to approach it with humility. And it is evolving across the country. And I see so many different, approaches to it. So it's not who comes up with the most laborious list. That's the superior one. It is what's achievable, and is there movement? Are those outcomes, when taken together, are you going to create some level of change? And it is not easily done. And so I just want to put that overlay on that. I think it's important to measure. I think it's important to have metrics. The obvious one that we've always had, particularly in community development, is around the area median income and what you're trying to hit. That's a no-brainer. But when you start getting into some of the other areas, even when you go into, particularly with the uprisings of last year, the lens of diversity and equity and inclusion started being added everywhere. And I think that's all over the place in terms of how you measure that. And so the articulation of that as a goal is easy. The measurement, the execution of that is something else. And so I just think with humility, we have to keep saying we're going to evolve, we're going to keep moving forward, and hopefully we'll continue to learn and learn from each other, as we go. But I see managers come in, again, with my foundation hat and or the CIO world, and they all try to say, well, I have a secret sauce of what we're doing. I just roll my eyes. Not a secret sauce. It's all very, very similar to each other. And there's something I think that can be learned. And unfortunately, it's not standardized. And I say that that's unfortunate, because when I meet with other foundation heads, we're all like, we wish there would be a common platform rather than everybody wanting to have bespoke. But the way the industry is set up, if you can say you're bespoke, then maybe you have a better shot with the LP. So there are some perverse things that are in there that I think have to be corrected.
Thank you for the landscape perspective, Ray. Andy, we'd love to hear from you as far as the impact measurement elements that your organization looks for when it comes to outcomes of your investments.
Yeah, first of all, seconding everything Ray said, particularly around the notion that none of this is a secret sauce, right? There's different ways of doing it, but all of it revolve around the same basic common sense, right? None of this is logarithmic. So just all of that. I guess not wanting to give a laundry list of the things that we try to measure, I'll just reflect on some change that we're trying to make in that, in the way that we do it over the course of the last year. You know, like any organization, we've been reflecting on what are our shortcomings as we think about questions of equity in our work. And certainly there are many. And one of the evolutions of thinking that has come out of that, and, you know, as always, important to acknowledge that it's ongoing. But one of the thoughts that has come out of that is the notion that a lot of what we were measuring amounted to inputs to wealth creation. You know, is housing affordable? Is fresh food accessible? Is healthcare accessible? That kind of thing. And we were doing less actually to measure wealth creation itself and recognize that wealth creation is its own objective, and that its linkage to power, as Ray was talking about before, is so important. And so we're trying to think about and put more centrally the goal of wealth creation, especially for people of color and disenfranchised communities in our work, and measure more of that.
That's great, Andy, and I think it's a testament to the evolution of the space, moving from measuring your kind of activities to really trying to measure the long-term outcomes. Paul, we'd love to hear from you. I know you mentioned you have a lot of things that you look for, but maybe your overarching strategy on impact measurement and management would be great to hear.
Sure. I think one key point to make is, from an overarching perspective, we have a fiduciary duty to deliver returns to our client. And so whatever impact we are assessing in a project, let's say, needs to be accretive to the business plan. It can't be a concessionary, impact-driven decision that this would be nice to have, but we're not going to get any return. It's just a cost to us. So we look at everything across all of the investments with that in mind. You know, is this going to be met well by the market? You know, does this serve a market need as well as a social need? And that's sort of our overall framework for looking at it. And then you're right, we have all of these different criteria, and it's not necessarily keeping criteria in order to force that on a developer, because that would be contrary to my first point. You know, like, we wouldn't be telling the market, you need to build a net zero energy building here, if it's not going to be accepted by the market or anyone's not going to pay for that. So we keep that because we need to develop internally our own language to talk about how to compare lots of investments from an impact profile. We have a really accessible language on the financial side. We could talk about IRRs and equity multiples and cash on cash yield, but we don't have the same language yet from trying to compare different investments across impact outcomes, and what is a good investment, you know, from that perspective, and how, you know, who has the best ideas about capturing as much impact as possible in a business plan that also delivers alpha. That's really the point that we have in developing this checklist, is to try to develop towards that impact metric. And, you know, I think as both Ray and Andy has said, we are humble and struggle along with that as much as anybody else. We don't have the solutions. We are trying to figure it out. And I think it's quite possible it'll never be figured out, because it is so diverse and so subjective that it's just a matter of learning what works and trying to replicate and trying to expand from that.
That's great, Paul. That's great. So I know that we're looking to wrap up here in the next couple of minutes. So I'm going to have one last question for the group, and I'm going to call out that we did have a article released this morning written about the work of the collective and the $100 million raise that's getting kind of launched now, and for the collective investment group's first investment strategy for the developers that we'll hear about later today. And so as we wrap up today's call, and starting with you, Andy, and we'll take it around the circle one last time, what advice would you give the collective investment group as they move forward into this raise?
I want to preface this by saying that this is essentially the same advice that I give anybody who asks me this question for any kind of fund, because it could be heard as, there's not enough good investable opportunities steered by Black people, and that is explicitly not what I'm saying. I don't think that that is the case. But what I would say is focus on developing the pipeline of investable opportunities, and the money will follow. Investable opportunities are harder to come by than money in the current environment. And again, that is true whether you're talking about clean energy, or whether you're talking about luxury housing, or whether you're talking about the collective, right? It's not about that. I think I see, I talk to some number of fund managers every year, and very frequently, what does your pipeline look like is the hardest question for them to answer, regardless of what sector they're in.
Great advice, Andy. Paul, we'd love to hear your thoughts on the same.
I have one thought. $100 million is a great number, and it's a large number, and really well suited to institutional investors like us. And I guess the advice that I'd give is that to be authentic to what you want to achieve, figure out the ways that you're not beholden to investors like us. Figure out the ways in which 25 million of that or more can be like a political campaign, small dollars, that come from the community, so that the communities that you're developing in, those investors get to create wealth from the investments that we're all making, right? Multiply what we're able to do, so that there's wealth created from it for everybody, right? Spread out the benefits.
That's great, Paul. Yeah. And Ray, bring us home with your thoughts.
Well, I think that the two comments were by Paul and Andy were very insightful, particularly when Paul said, you don't want to be ruled by the fundraising campaign itself to take you away from the deep community development work. And so they're not exactly the same thing, and pipeline building is really important. So I think those are probably two of the most important things. I'm going to add a third, and to close out, and it's something that I've never forgotten. And this whole effort, everything is about people, and it's people who inspire you, because you will have ups and downs, and sometimes you'll have doubt. And some of the worst doubt comes from the inside, but you'll often have people who will express disbelief. So my inspiration and mentor, and a person that I got to work with before he passed a number of years ago, was the late Jim Rouse. And we started Enterprise, but can you imagine somebody saying, I'm going to build a city from scratch? That's what he did. And he used to tell me stories about it. And what he always said was, his expression was, what ought to be can be, if we have the will to make it so. That's what I would share to them.
Ray, I love that. I think that's a beautiful note to end it on, and may our wills make it so as we move into this ambitious effort on behalf of Philadelphia for and by the collective developers that we will get a chance to meet all this afternoon. Thank you, Ray. Thank you, Andy. Thank you, Paul, for being with us here today. And with that, we'll close it out.